In this video, traders, we're going to look at should you invest in stocks now, and if so, how? Stay tuned. Hey guys, warm welcome to you. Right, so as I'm filming this, we're in the depths of a hammering from the coronavirus. The stock market is well and truly smashed off its highs. Some stocks are being absolutely decimated, others are just taking a bit of a haircut. And one of the things that people consider is, hey, is it a good time to invest in stocks? And I speak to people all the time from different walks of life, and the majority of people come out and say it's a great time to buy and things are going to bounce back. Now, the problem is that those people said that when we're off a little bit off the high. So, you've got this scenario here where, the market kind of did this and people saying, oh, it's a great time to buy, and now the market is down here and they're way off. So it's not as simple as that. We know that as traders and investors, but that seems to be the general consensus. Now, is it a good time to invest in stocks? Now, I don't know the answer to that because the situation is changing almost daily. However, what I can say is this: you've got a few ways that if you think that the market is going to bounce back at some point and your time horizon is long enough for this and all this kind of stuff, there are a few ways of perhaps mitigating the risk of doing so. Of course, the risk of we have a very real risk for the first time, I think, in a long time, that things can get very, very bad. And so, if we're deciding to invest any money, we've got to be prepared to take losses. We've got to be prepared to sit with things that aren't going to go your way. Because something that kind of came up the other day is, okay, if you buy a stock, everyone wants it to go up, and that would be great. If you bought a bunch of stocks and they went up over the next couple of years, then fantastic. You've bought the dip, so to speak, and that's exactly what you're trying to achieve. The other thing, of course, is that the stock you buy goes bust. That's perfectly applicable in this environment, guys. We're at very, very interesting times where their companies will go bust, in which case you lose all your money. The other scenario, of course, is that you time it wrong and the market goes lower and then it just sits there. So it might not go bust, it might become kind of like a zombie company, in which case it just sits at lows, maybe 80% off your buy price, and it's as good as a complete wipeout as anything, because it's going to sit there forever. It's just really ticking over to provide jobs for people. It's not making any money, and we know there's companies out there already that are doing that. So after this, there might be a load of zombie companies that are like that. The other thing is, if you time it wrong, if we go another leg the same as that lower, we might get a big bounce off the bottom, but it might only take you just a little bit back into profit. So it's tricky. It's very, very tricky. I know there's a lot of stocks out there that look attractive from a perspective of some of the dividends now. Some of the big companies that have been around for years are trading at very, very discounted levels, and the dividends look attractive if they can continue to pay the dividends, of course. Who knows? They're not making any profit, they're not paying any dividends. They could slash that dividend in half in a heartbeat just to keep going. And some of these guys could go, but there's all sorts of stuff. But you know the score of that. Okay, so the three ways that you can if you decided to invest in a basket of stocks, you've done your due diligence, you've picked some of the stocks you think are strong, or you've picked some of the stocks, you might pick some stocks that you know are probably going to be okay over the long term unless you have a catastrophic economy. Some of the stocks that have got so much cash on their balance sheet, really strong brands, all this kind of stuff. No need to go through the things. I've done kind of screen-based videos before to give you guys some ideas on stuff like that, but you'll probably have your own. You might have those you consider slightly safer, if there is anything in this environment. And you might have some which are just pure recovery plays, so kind of all or nothings. So stuff that has just got absolutely hammered, looks like it's about to go bust, but if they manage to get through the next kind of 6 months by the skin of their teeth, then they might be able to claw back a recovery, in which case you might see kind of tenfold return on your investment. But you recognise that there's a danger there of them going bust. So you might mix them up. Anyway, enough of that. The kind of three ways, there are more, and if you want to add some more in the comment section below, please feel free to contribute, guys. I think there's three ways of getting involved in stocks if you wanted to invest. The first one is that you just go all in. In other words, not all in as in, we're not talking about full net worth long in stocks, that wouldn't be sensible. But you're saying, okay, I'm allocating X amount of capital to put to work. Let's say 10 grand, 50 grand, 100 grand, £500,000 quid, whatever you've got or you want to risk. and you go, right, I'm going to pick my stocks, I'm just going to buy them now. Now, the danger of that is, say if you get it wrong, let's say the people who went all in there are now sitting on probably a pretty hefty loss percentage-wise, and yes, if we recover back here, they'll be fine, but timing it like that is challenging. It's challenging enough for traders when we're trading short-term, let alone for investors long-term. The other way to do it is to stagger your order, or stagger your entry over multiple weeks or months. So say if you have got 100k to put in, or 10k, whatever it is, you split it up, let's say into 6 months, 10 months, whatever time period you want, and you dollar cost average in. So you just go, right, I'm going to put $1,000 in here, or 2k here, 2k here, 2k here, over a 10-month period, there's your 20k into the market. And what that does is it smooths out things. Obviously the advantage is if the market keeps going lower, you're kind of adding and adding and adding. If the market bounces up, of course you're paying higher and higher prices, but you're smoothing out your entry. So if it does go lower, you're kind of there. Obviously, if it keeps going lower after you're out of bullets, then it's bad luck, but at least it's a little bit better than buying right at the top. If it starts to rally and it's picking the bottom, it's okay, because at least you've got some at the lows, but you're kind of putting your price up. And it's not foolproof, guys. It could rally and then crash through the floor again, but that's one way of doing it, kind of scaling in to the position. The other way, that's over a kind of time period. The other way is to kind of scale in from a monetary perspective. So you go, right, I've got X amount per stock here. As it starts to go lower, I'm going to add. That's dangerous because you end up being in the stocks at the worst. You have to go to zero, like from the cruise ships at the moment, or cruise companies at the moment, they're getting hammered. If you've scaled in, you've been in the biggest position on the worst possible markets. Something like Amazon, which hasn't got hammered so much, you've been a little bit. So you've got to be careful of that. But scaling into the upside is something that possibly has some merit to it. So you've kind of framed the distance from high to low. And you go, right, okay, once we start to see a recovery, if we do, I'm going to kind of accept that I'm not going to get the lows, but I'm going to kind of buy as we pick up off the lows. And so, okay, you're not getting the very best prices here, but you're de-risking things slightly. So you're kind of ensuring the company's not going to go bust. So you're kind of hopefully assuming that you're not going to wipe out your investment. So once that's assured and you kind of, there's some guidance put out and there's a plan of action to recover, then that de-risks it a fair amount. Not taking the risk off completely, but it de-risks a fair amount. And the kind of flip side of that is that you'd have to pay a higher price, but you'd probably still get obviously hefty discounts to what the stocks were trading at before. But you kind of give what you take. So you miss out on some of the potential bounce off the low, but you kind of de-risk it a little bit. That's one way of doing it. Wait for a recovery rally, wait for lots of good news to start coming out, forego the lows, and then start to pick things up as they maybe push back to highs. Again, not foolproof, could roll over again, nothing's foolproof. But there's some ways and ideas of, if you're thinking about maybe investing in stocks, again, definitely not advice to, who knows what's going to happen. You need to be very comfortable with the risk, and this is very risky times, guys. But a couple of ways of getting involved if you choose to do so. If you've got any other ideas, and stick them in the comment section below. Take care and see you next one. Bye bye.